Hey folks, welcome back to Macro Crazy. Tonight I'm going to do something a little bit different. Yes, I'll give the preview on releases coming up in the week. Early in the week, it's kind of quiet, but Wednesday and Thursday it picks up quite a bit. So tonight I'm going to talk about a couple of headlines that are coming across the wires that might be interesting and possible market implications. And then I'm going to cover a zero hedge article covering or talking about basically, thoughts, just items to think about going into 2023. Hope it's interesting. Okay, the first item I'll discuss is what's going on in China, which is the rioting. Uh, Supposedly there was a fire in one of the iPhone factories, but what's really keeping this rioting going is essentially, and this is what articles are saying, is that people are frustrated with the zero COVID lockdown policy, and they're fighting back. And they're saying no dictatorship. The guy in charge of China, Z, does not seem like somebody who's a coward. Definitely seems more in the thuggish category. So we'll have to wait and see what happens there. But if you were looking for a quick reopening to China, you know, may not happen if he is true to what he's typically done previously. So just keep that on the back burner and be aware of that. Additionally, one other thing, there was a zero hedge article, basically people talking about how small the crowds were on Black Friday, and suggesting that basically the consumer economy has collapsed. So, there can be all the debate you want about whether we're technically in a recession, but, certainly the bottom half of the consumer sector, they are feeling the pain, and that's showing up, on days like Black Friday. And I think I saw almost one fifth of Americans were skipping Thanksgiving due to cost. So, again, something to keep in mind. Okay, so we're moving on. I found another Zero Hedge article that was just posted very recently, and I want to talk about it a little bit. They're talking about key drivers moving forward, going into year end and early into 2023. So let's discuss them. First one they're talking about is the wealth effect is down. So stocks are down, bonds down. So 60/40 portfolio did not serve you well last couple of years. Crypto is down. So that's going to make people feel less wealthy. And that will ultimately trickle down to consumer confidence and consumer spending. So something to be aware of, and one of the reasons that a lot of the hedge funds have moved from consumer discretionary to consumer staples. Okay, so let's talk inventory. So one of the trends that have come up recently is what's called nearshoring, and that's a function of China's issues, global supply chain just basically shattering during COVID. So that's for the U.S. That's moving production maybe to, for example, Mexico, but that's kind of inflationary because the wages here are higher, even in Mexico, much higher than they would be in China. So something to keep an eye on. And as far as inventory goes, the expectation is it's going to remain high. Hard to work that down because basically consumer demand is all over the place right now. It surged during COVID. People were buying like nuts and they had the stimulus checks and whatnot. Then it just fell off a cliff and there was a mountain of inventory. And it appears, based on what I spoke about earlier, is the consumers have disappeared from the economy. No more stimulus checks. Tough times. You got inflation, trying to stretch their money. So again, they expect inventory to remain high. Now on to the favorite topic of the mainstream media, which is Ukraine. Ukraine on everything. That should be pretty much status quo for the foreseeable future. Certainly in the first half of 2023, which means it should be supportive of commodities, including energy. Doesn't mean necessarily they'll go much higher than here, specifically for energy, but it will be supportive. So, it'll might put a floor. Okay, so based on what I spoke about earlier about the rioting in China, it doesn't appear that there's going to be any near-term economic support from China. So that being the case, the global economy, excluding India, seems set to struggle. Back to the US. Okay, so as far as jobs go, they've held up reasonably well. And the thing you have to think about is it was so hard for companies to find and hire some of their talent, certainly in the last couple of years. So they would be slow to get rid of that talent. So they'll hang on longer than they might have otherwise in a normal recession. Where you might see cuts are more going to be in the peripheral jobs. So costs, like places that cost money and don't produce revenues. Moving on, let's just a brief chat on the service sector. That is kind of similar to inventory, where companies overbought because of consumer demand, and then they had an inventory overhang, which they're trying to work out right now. Service sector, when things started reopening, travel and restaurants and everything got a surge in demand. Is that sustainable? We'll have to wait and see. But did they overhire? Did they overinvest? Moving on. So we've talked a lot about inflation this year. 2023 should see more of a balanced discussion between inflation and actually a good amount of deflation talk. And we're already seeing some of that, for example, in car prices, especially used car prices. So that discussion will be more balanced, and it will add another layer of complexity if you want to trade the markets. One last item, one thing to keep in mind is that India has been operating under the radar, and they've been 6% plus growth. So they're now going to become the most populous country, I think, sometime soon, passing even China. So their demand for commodities of everything is absolutely surging. And this article is saying that it's kind of a stealth demand. People aren't aware of it. And much like China exploded onto the scene and in the 90s and early 2000s and was buying up everything, more and more demand could be coming from India. It's, again, supportive of real assets like energy, like food, like wheat, rice, anything. So again, something to keep in mind, real assets are what you want to own. Okay, moving on to the economic releases for the week. Monday is just a couple of Fed speakers. You never know, but should be relatively quiet. Tuesday, home index numbers, and then the bigger one would be consumer confidence. Okay, and then Wednesday it really picks up. You got ADP, you got Beige Book in the afternoon, revised GDP, home index numbers, Chicago PMI, a whole bunch of stuff to pay attention to, so don't fall asleep there. It continues on Thursday. We got PCE numbers, consumer spending, manufacturing numbers, weekly jobless claims is also in there, but again, not a huge driver. It's so volatile. And we got a Fed speaker as well. Okay, closing out the week, we got the non-farm payrolls. That's the big number on Friday. Unemployment rate, of course. Average hourly earnings. Average hourly earnings. Can't speak today. And we got a Fed speaker. And labor force participation rate is in there as well. So Wednesday, Thursday, Friday should be busy. You can ease into the week tomorrow. Set your positions up for what you think is going to happen based on your top-down view. And good luck to you